Hello and welcome to the first part in our market research journey, the market health analysis or industry analysis. Let's jump right into it, shall we? I hope you'll find it educational. Doing an industry analysis is all about understanding whether the industry or market is healthy or not. We have 4 health indicators that can tell us more. The first indicator is the size of the market. You don't want to launch a product in a market that's smaller than your annual revenue or where potential sales volumes are not covering your fixed costs, for instance. The second indicator is the growth of the market. A market that's shrinking is usually not a good sign, so you want to steer clear from those markets. The third indicator is the life cycle of the market. Having this information will help us to time our market entry. You don't want to enter a market that's already in a contraction phase. And the fourth indicator is how much market share you'll be able to capture with your product. Let's start with estimating the market size. In order to estimate this, we need to define the scope of the market. This may include identifying geographic boundaries, the product or service offerings within the market, and the target customer segments. Once the scope is defined, you can start to gather data to estimate that scope. This can include data on population, demographics, consumer behaviors, and industry reports. Check whether you have access to public databases in your country. Interviewing industry experts is also a good way to collect data if you have access to their expertise. To quantify the size of the market, you can use a combination of top-down and bottom-up approaches. The top-down approach gives you a rough estimate of the market size, which you can cross-check with a more refined bottom-up approach, where you start with one unit that's extrapolated to the entire population. Let's first look at the top-down approach. Here you want to write out your formula on how you want to compute the size of the market. This makes calculations easier, as you then just have to fill in the missing numbers. Say, for instance, you want to compute the annual market size of smartphones in the US expressed in US dollars. In order to calculate this, I will first write down my formula, starting with the annual volume of smartphones purchased in the US. So I need to know the total population in the US, the percentage of population with a smartphone, and the percentage of population that will replace their smartphone this year. Multiplying all these parameters should give me a rough estimate of the volume. Next, I would compute what a smartphone costs on average in the US. Let's take an average of $1,000 if we mainly account for the newer models. And finally, I would multiply both figures together, which gives me an approximation of the total annual market size of smartphones in the US. Okay, so that was the top-down approach. It gives us a basic idea on the market size. However, it's not sufficiently refined to use as a final market size estimate. That's why we also should do a bottom-up approach to cross-check the top-down estimate. This approach typically takes longer, as you need to crunch the numbers, do research, and discuss assumptions with industry experts. So that was the first indicator. In addition to analyzing the current size of the market, it is important to assess the potential for growth. This can include analyzing trends in consumer behavior, technological advances, and changes in regulation. By understanding the potential for growth, businesses can identify opportunities for innovation and investment. There are many forecasting methods out there, like compounded annual growth rates, seasonality growth rates, moving averages, etc. Tackling each one of these would take us outside the scope of this course, so I would just suggest to simply use an average growth rate equal to the historical growth between 2 fixed periods in time. So okay, that was the size and the estimated growth rate. Another aspect that we need to touch upon is the market cycle. Markets tend to follow this fixed pattern, if you will. It consists of 4 stages, being expansion, peak, contraction, and phase out. In the expansion phase, economic activity is increasing, businesses are growing, and employment is rising. As a result, consumer confidence is high and demand for goods and services is strong. This leads to higher prices and profits for businesses and investors. This is the best moment to enter the market. At the peak of the market cycle, economic growth begins to slow down and the rate of expansion starts to decrease. Businesses and consumer confidence can still be relatively high, but growth is starting to plateau. This is often a time when investors and businesses begin to take profits and our more cautious investors start to exit the market. You might still be able to make some profits because you have some players that are already leaving the market and leaving up some gaps that you can fill in. In the contraction phase, the economy begins to shrink and businesses may start to cut costs, reduce hiring and decrease investment. Consumers may also start to pull back on spending, which can lead to decreased demand for goods and services. This can lead to a decline in prices and profits, and investors may become more risk-averse. My advice would be to not enter anymore, unless you have a product that will revolutionize the market, but that's quite a bold strategy. Finally, in the phase-out stage, the economy has bottomed out, and economic activity is at its lowest point. Businesses may struggle to survive and investors may be wary of entering the market. However, this stage can also represent an opportunity for businesses and investors to buy low and position themselves for future growth. A good indicator to tell you at what point of the market, of the market cycle you are, is to look at the growth rate. If it's accelerating, we are in the first stage. If it's stagnating, we might be at the top. And if it's declining, then we might be in the contraction phase. Okay, now it's time to compute the market share that we would like to capture. It's completely normal if you don't have enough information at this point to answer this question. So I would suggest to come back to this part when you have more information about the segment you want to capture and what product you want to offer to them. The best way to approach a market share question is, when you don't have all the information yet, is to formulate some meaningful milestones and compute the market share that matches those milestones. Here's an example. The first milestone for launching a product could be revenues are covering initial investment costs done for developing the product. So here we want to look for how much volume we need to sell in order to cover development costs of the product. Once you know the volume, you should divide it by the total market share and see if that percentage makes sense. As a rule of thumb, don't expect to capture more than 5% of the market the first year. The second milestone that you want to reach is the break-even point. Here you want to take it a step further and compute how much we need to sell before our revenues are covering the fixed and variable costs. And the next milestone is completely arbitrary. This is more of a strategic objective that's set between you and management of the company. It should remain realistic, however. So overall, you want to enter an industry that's in good health, meaning the size of the market is sufficiently large and allows you to take a market share at which you're profitable, and the market is still growing, indicating that it's either in an expansion phase or at a peak phase. And voila, that's about it for the market health analysis. Don't forget to hit the like button and to subscribe. That way you'll help the algorithm and you will stay up to date with the latest content. Also, don't forget to have a look at my masterclass on product strategy creation. You'll get a much more exhaustive view on how to leverage your market research with your products or services. You should find a link in the description below. Okay. In the next video, we will cover the customer analysis part. See you there. Bye.